A big, a big rebound for AI stocks today as the Nasdaq surges. The question is, was last week just a momentary blip or something more serious? Let's ask Glen Kacher, Light Street Capital's founder and CIO. Welcome back. It's good to see you.
Good to see you, too.
So is this trade intact or not?
I think absolutely. I mean, you look at the usage and growth of revenues for AI, and it's still incredibly stunning. We're seeing revenue growth at OpenAI tripling for the third year in a row. Anthropic is growing 8 or 9x year over year. Google AI products revenue, they announced recently on the call, is tripling year over year. Google's Gemini AI search overview coverage has gone from 0 searches to over 50% in the last year. API calls on Google Gemini are up 14x over the last 16 months. Absolutely, the AI, power is there. The question is, right, how quickly we can make profits from it, these companies. And by the laws of accounting, right, gross profit must eventually exceed OPEX and depreciation from CAPEX in order to be profitable.
Sure.
And at the current price being charged, anywhere from free to $20 a month, demand for AI is greatly exceeding supply. And but revenue is not yet exceeding costs. So we are on a path to profitability, but we have to see that has to be proven out over the next 1 to 3 years.
Well, we seem to be scrutinizing that more heavily, starting with Meta's earnings report, right? I mean, that's what it felt like in the market, because I don't think anybody would disagree with the fundamental cases that you just laid out, one by one, for the stocks that you like and the ones that you own. But the market last week, anyway, seemed to be fixated on numbers like 100 billion and 80 billion and 75 billion, the money that these companies are spending to try and get to where you think they will get to.
Yeah, I mean, you look at it, if you add up the Mag 7, ex NVIDIA, of course, they're spending around 73% of next year's operating cash flow on CapEx. And but there's still a lot of capacity there. They're able to borrow, they're able to raise equity financing if they want to. That will cause some people to ask questions, right? But I think as we move through the year, we're going to see those prices that they're charging for these AI services go up.
Do you have any issue with the level of debt that these companies are raising to fund the infrastructure build-outs?
Well, I think it's a question of how they're financing everything. I think there are companies in much better shape than others. I mean, if you look at the neo clouds, for instance, we're not touching those. We don't like the way they're being financed. We don't like the contracts that they have with their customers. So we're staying away from those. But we look at a company like Google, where it's arguably positioned better than OpenAI for capturing the AI demand out there, and we want to own that stock.
Are you short some of those names in the so-called neo cloud? I mean, there are ones that are well known to our audience. Like, I guess you would put a CoreWeave in there, wouldn't you? Well,
I think you have to be really careful shorting what I think are somewhat meme stocks, and we have to. It's kind of scary to me right now when I look at the conversations going on around investing and what happens on the internet and what consumers are doing. I recently was on X and I saw someone saying it's their son's 21st birthday. Should they give him a Robinhood account to day trade stocks, or should they give them a Fidelity account to be a long-term investor? I mean, that's like asking whether or not you should take your son to the bar and get him a beer for their 21st birthday or take him to some sort of drug dealer. I think we got to stay away from that. I think people have to be reasonable. They have to look for returns on capital. And I think there's a whole lot of names that have exposure, especially in the semiconductor sector, that have exposure to real profitable business models and real demand coming from AI usage.